Hello guys, welcome to another deep value video. Today taking an in-depth look at Albertsons Companies Incorporated, an American grocery company founded and headquartered in Boise, Idaho. As of the 8th of January 2025, the stock is priced at $19.7 with a market cap of 11.3 billion. They trade at a forward PE of 12.5, just slightly above their median 10-year PE of 11.8. Their price to cash flow is 4.2 and their forward dividend yield is 2.45%. The revenue has grown by 26.9% over the past 5 years. Their net income has increased by 26.9%. Their earnings per share has increased by 178.8%. Their common shares outstanding have increased by 0.1%. Now, taking a closer look at the liquidity and solvency, we can see that their interest coverage ratio is 4.36, to be honest, a bit too low. Their quick ratio is 0.22, also this is actually pretty bad. But of course, they're a grocery business, so this is not really that big of a problem since grocery businesses have low quick ratios. Since the quick ratio supposes that you calculate it without inventory, so you calculate current assets minus inventory over current liabilities. The long-term debt equity ratio is 2.43, which is, to be honest, very bad, and their debt equity ratio is also 2.47, which suggests a very high debt load. The cash from operations has increased by 39.7%. The cash from investing has increased by 361.9%. So we can see that they're making big investments. The cash from financing has decreased by 41.3%. The capex has increased by 37.7%. The free cash flow has increased by 18.9%. Taking a closer look at the return metrics, you can see that ROE is close to 60%, the return on investments is 15%, the return on assets is 6%, and the return on invested capital is 6.5%. Now, to assess fair value, I've used a DCF valuation, a multiples valuation, and analyst expectations. The DCF valuation is $14.63. The multiples valuation of 11 times earnings, 11 times operating cash flow, and 14 times free cash flow is $28.36. And the analyst expectations is $23.4. Calculating the average, we get an intrinsic value of $22.13, and using a 50% margin of safety, we get an acceptable buy price of $18.81. So the stock is trading near to their acceptable buy price. Now, to conclude, I believe that this is not a buy. Although they're trading almost at a 15% margin of safety, this is not a buy because their balance sheet is, to be honest, atrocious. And there are much better opportunities in the market right now. Now, I personally don't really like grocery businesses, retail in general, just like Warren Buffett. I think retail is not the greatest. Costco is one of the biggest exceptions to this rule, but Costco is trading at huge premiums, so I'm not taking it into account. But if you really think about it, other than Costco, most of these businesses are just big wasters. If you were to invest in the top 50 grocery businesses on the stock market in 2000 or 1990, you probably lose a lot of money up until now, or just be destroyed by the S&P. So these are not really that great businesses. We can see in the balance sheet, we can see that their net income and operating cash flow are cyclical. We can see that they're too reliant on huge inventory and also huge capex. So this is just an all-around bad business. Actually, I did an analysis 2 days ago on a company. I do not remember its name. You can check it out on on my YouTube channel. It was in the steel rebar business, if I remember correctly, and it was a much better opportunity than this one. So I think you should go check out my other video from 2 days ago. That's a company you should probably invest in, not this one. Uh, yeah, I'm not sure what you can see here. There's really not much to see on this company. If their price drop to, I don't know, $13, then yes, there'll be a value play. But for now, they're just too expensive, in my opinion. There is not really much to see here. Now, to end my video, please check out Ticker Data. The Ticker Data is a partner of ours, an affiliate partner, and They offer real-time financial data on Excel and also a lot of spreadsheets, a great community and a lot of spreadsheets on Excel, where you can, for example, check out your portfolio. You can do a DCF, you can do a DDM, dividend discount model. There's a lot of things on there. You should check them out. I've left the link in the description. Also, don't forget to check out my investing blog from the description below, where I do in-depth analysis. Thank you for watching, and I'll see you in the next video. Bye.